Imagine you wake up tomorrow with $100 in your bank account, no strings attached. The big question is, what's the smartest way to turn that $100 into something much bigger in 2025? Investment. Too many people waste opportunities like this on quick purchases that lose value within days. But if you think differently, that same $100 can be the seed of long-term wealth. The key is not chasing flashy promises or get-rich-quick schemes, but instead using smart, strategic investments that compound over time. Today, I'm going to walk you through exactly how I would invest $1,000 in 2025, step by step, so that every dollar is working as hard as possible for you, both now and in the future. If I had $1,000 in 2025 and I was deciding where to put it, the very first step would not actually be investing, it would be securing the financial foundation. Too often, people rush into the stock market or crypto because they're excited about potential gains. But what they overlook is that those investments won't matter if they're not protected from financial emergencies. The truth is, investment, no matter how good the investment looks, if you're caught without cash when life throws a curveball, you'll end up selling at the wrong time or relying on expensive debt. That's why the smartest first move is to build a small emergency buffer and eliminate high interest liabilities before thinking about growth. Let's think about it this way. If you carry a balance on a credit card with a 20% interest rate, every dollar you put toward that debt is essentially giving you a guaranteed 20% return. No investment in the stock market can consistently promise that kind of return without risk. Paying down high interest debt is like giving yourself an instant risk-free profit, and it frees up your future cash flows so you can invest without the weight of financial stress. Even if it doesn't sound exciting compared to picking stocks or chasing trends, it's the single most effective use of a portion of that $1,000 once the debt side is handled. Or if you're lucky enough not to have any, the next layer of the foundation is an emergency fund. Now, with only $1,000, we're not talking about setting aside 6 months of living expenses. Instead, the idea is to carve out a few $100s into a high-yield savings account. These accounts in 2025 are paying significantly more interest than they did just a few years ago, so your money can grow passively while remaining liquid. Investment. This small cushion protects you from having to liquidate investments in the middle of a downturn, which is when most people lose money. Imagine if your car breaks down or you suddenly need to cover a medical expense. Without an emergency fund investment, you might have to sell stocks or crypto at a loss, wiping out months or even years of progress. Having a safety net ensures that your investments stay untouched and continue compounding in the background. Psychologically, this step also builds confidence. It might feel small, but having a few $100s set aside in cash is like insurance against panic. Investing is not only about numbers, it's also about behavior. People who skip this step often panic, sell when they need money quickly, and that single mistake can undo all the careful planning. On the other hand, if you know your basic emergencies are covered, you're free to let your investments grow without constant worry. Another benefit of starting here is flexibility. By placing part of the $1,000 into a savings account, you maintain liquidity while you educate yourself and look for opportunities. Investment. Maybe you only put $300 into that account, but in doing so, you buy yourself time. You can then deploy the remaining $700 with a clear strategy rather than rushing in. This prevents emotional decisions and makes you think like a disciplined investor. It's also worth pointing out that securing the foundation is not just about math, it's about mindset. If you build wealth on top of shaky ground, eventually you'll be forced to pull it down to cover gaps. But if the foundation is solid, every dollar you invest afterward has a chance to work for you uninterrupted. This is why even seasoned investors always talk about risk management first. It's not about how much you make, it's about how much you keep and protect. In 2025, the world is more unpredictable than ever. Markets move faster, job security isn't guaranteed, and costs of living continue to rise. By making sure a portion of that all $100,000 goes to shoring up your financial base, you're essentially buying peace of mind and creating the conditions where your investments can thrive. It's not glamorous and it won't make headlines, but it's the kind of boring, steady decision that separates people who build real wealth from those who gamble and lose. So before putting money into index funds, ETFs, or emerging trends, I would use a slice of that $100,000 to pay off any high interest balances and start a small emergency cushion in a high yield savings account. This step ensures that when the real investing begins, every dollar is positioned to stay in the market. Investment, grow without interruption, and compound into something far greater. It's like building the foundation of a house. Without it, nothing else stands. With it, everything else becomes more stable, more predictable, and ultimately more profitable. Once the financial foundation is secured, the next step with that $100,000 is to put a large portion into something that historically has built wealth reliably, index funds and ETFs. These are not flashy. They don't promise overnight riches, but they are one of the most proven ways to grow money steadily over time. The beauty of index funds is that instead of betting on one single company, you're spreading your risk across hundreds, sometimes even thousands of companies in one investment. This diversification is what protects you from the volatility that often scares new investors out of the market. Think about it this way. If you put your entire 1,000 hours into one stock, you're betting on that company's ability to succeed. If it fails, your money disappears. But if you put the same amount into an S&P 500 index fund, you're essentially buying a slice of the 500 largest companies in the United States. Some of those companies might struggle, but others will thrive, and the overall performance of the group has historically gone up over time. That's the power of diversification, and it's why index funds are a cornerstone of smart investing. The real magic, however, comes not from picking the perfect investment, but from letting compounding do the heavy lifting. Imagine you put 700 of that $1,000 into an index fund. If the market averages 8-10% annually, which has been the long-term average of the stock market, then that 700 could double in roughly 7 to 9 years. And if you consistently add to it, even small amounts like 50 or 100 a month, you transform that one-time 100,000 seed into tens of thousands of dollars over the next couple of decades. The earlier you start, the greater the effect of compounding, because your gains themselves start to earn gains. Another advantage of index funds and ETFs in 2025 is accessibility. Brokerage platforms now allow you to buy fractional shares, meaning you don't need thousands of dollars to get started. Even with just 700, you can buy into high-quality funds that track the entire U.S. market, international markets, or specific sectors. And since many brokerages have removed commissions, your money goes directly into investments without being eaten up by fees. Low-cost funds, especially those with expense ratios under 0.1%, ensure that your money is working for you rather than being siphoned off by management fees. A common mistake people make is believing they need to beat the market. They chase hot stocks, jump into hype-driven trends, and try to time the ups and downs. The truth is, almost no one consistently beats the market over the long run, not even the experts with billions of dollars and advanced algorithms. By choosing broad market index funds, you're not trying to outsmart the system. You're aligning with the growth of the entire economy. As companies innovate, expand, and generate profits, you benefit as a shareholder. It's simple, it's boring, but it works. Another important factor here is emotional stability. When you invest in a diversified fund, the ups and downs are smoothed out compared to picking individual stocks. Sure, the market will still have downturns, sometimes severe ones, but history shows that it always recovers. If you can stomach the volatility and stay invested, you eventually come out ahead. That's where the earlier emergency fund comes into play. It prevents you from pulling money out of your investments at the worst possible time. Let's say you put 700 into a total stock market ETF in 2025. If the economy grows, your investment grows with it. But even if 2026 brings a recession and your 700 dips to 500, the key is not to panic. In fact, downturns can be opportunities because they allow you to buy more shares at a discount. Over the years, these cycles balance out and your investments trend upward. The biggest mistake people make is pulling out when things look bad, only to miss the recovery. By committing to index funds, you're committing to stay invested long-term and let the natural growth of markets do the work. One more benefit of this approach is flexibility. Index funds and ETFs come in many forms. Some track the overall market, while others focus on specific areas like technology, healthcare, or international growth. If you want broad exposure, you might put money into something like a total stock market fund. If you believe global growth outside the US will be strong, you could allocate part of it to an international ETF. The point is, you have choices that allow you to diversify not only across companies, but across entire economies. In summary, if I had 1,000, a large part of it, around 700, would go into low-cost index funds and ETFs. This strategy doesn't require constant monitoring, deep financial knowledge, or endless research. It requires patience, discipline, and trust in the long-term growth of the economy. While it won't make you rich overnight, it sets you up for steady, sustainable wealth. Over time, this boring but powerful method can outperform most active strategies and provide the kind of financial security that frees you to pursue bigger goals. Once a solid portion of that 1,000 is placed into safe, diversified index funds, the next step is to take a calculated risk by putting a smaller percentage into emerging trends. This is the part of investing that allows you to capture potential outsized gains, the kind that could turn a few $100s into several thousand over time. While index funds provide stability and long-term growth, emerging sectors provide the possibility of exponential upside. The trick is not to go all in, but to carve out a reasonable slice, perhaps 15% to 20% of the $100 and place it where the future is being built. In 2025, there are several industries that stand out as transformative. Artificial intelligence is the most obvious one. It is already reshaping businesses, healthcare, education, and even creative industries. Companies that are leading in AI development, whether in software or hardware, have the potential to grow massively as adoption increases worldwide. Investing even a modest amount into an AI-focused ETF or a few strong companies within the sector could give you exposure to this wave. The beauty of allocating only a small portion is that if it doesn't work out, your losses are limited. But if it does work out, the upside could be substantial compared to more traditional investments. Another sector worth considering is clean energy. The global push towards sustainability, the transition away from fossil fuels, and government incentives are driving innovation in solar, wind, battery technology, and electric vehicles. Companies that build the infrastructure of clean energy are likely to benefit from massive spending programs and global demand. With climate change being one of the defining challenges of our time, clean energy investments are not just financially smart, but also aligned with future necessity. Blockchain technology and digital assets also remain part of the emerging trend conversation. While the hype around cryptocurrency has cooled and volatility remains high, the underlying technology is finding real applications in finance, supply chains, and data security. Investment. The key here is not speculating on every token that comes along, but looking at companies building infrastructure for blockchain adoption. Whether it's payment systems, decentralized finance, or digital identity, the space is evolving. Even small investment. Cautious exposure could provide significant gains if these technologies achieve mainstream adoption. It's important to understand the psychology of investing in these sectors. Many people either avoid them entirely because they seem risky, or they jump in recklessly, putting far too much of their portfolio into something unproven. Both extremes are dangerous. The middle ground, allocating a controlled percentage of your money, lets you participate in the growth of the future without jeopardizing your financial security. Think of it like planting a few seeds in fertile but uncertain soil. Not all of them will grow, but the ones that do could yield an impressive harvest. Let's make this concrete. Suppose you set aside 200 of the thousands for emerging trends. You might put the 100 into an AI-focused ETF that holds a basket of companies building and applying artificial intelligence. Then you place $50 into a clean energy fund that tracks the performance of renewable energy companies. Finally, you take the last of $50 and carefully select a blockchain, related company, or ETF that gives you exposure without going all in on speculative tokens. In doing this, you've spread your bets across 3 high potential areas, each with the ability to scale significantly in the coming years. Another benefit of investing in emerging sectors is the knowledge you gain. When you put money into a trend, even a small amount, you naturally become more engaged. Investment. You follow the news, read the reports, and learn how the industry operates. That education itself has value. You start to spot patterns, understand risks, and identify real opportunities beyond the hype. Even if your 200 doesn't multiply, the lessons you learn could inform larger investments later on when you have more capital to deploy. Of course, the risk with emerging sectors is real. Some companies will fail, some technologies won't live up to expectations, and valuations can swing wildly. But by keeping your exposure limited and diversified, you insulate yourself from catastrophic losses while still allowing the chance for meaningful growth. It's about being positioned to benefit from the next big wave without drowning if it crashes. This step is also about mindset. Many people only invest in what feels safe, but the biggest wealth builders often have at least some exposure to innovation. Imagine being invested early in companies that dominated the internet, smartphones, or e-commerce. A small position back then could have turned into life-changing wealth today. The point is not that every emerging sector will produce the next Apple or Amazon, but that by putting even a small slice of your portfolio into these possibilities, then you give yourself a chance to participate in the story of future growth. So, with 100,000 in 2025, I would not ignore the sectors shaping tomorrow. I wouldn't gamble my whole portfolio on them either. Instead, investment. I'd strategically set aside a manageable percentage, invest in AI, clean energy, and blockchain opportunities, and hold them with patience. If they succeed, even a few $100s could yield multiples of the original investment. If they fail, the foundation of index funds and savings ensures my wealth building journey stays on track. It's about balancing security with potential, stability with innovation, investment, and creating a portfolio that benefits from both today's proven methods and tomorrow's possibilities. When people think about investing, they usually picture stocks, bonds, or real estate. Investment. But the most overlooked and often most profitable investment is not in the market, it's in yourself. If I had Versnows in 2025, I would dedicate part of it to increasing my own skills, knowledge, and earning potential. Unlike stocks, which fluctuate with the economy, or emerging sectors, which can succeed or fail, personal growth has a nearly guaranteed return. When you invest in yourself, you're creating a skill set that nobody can take away. Investment, and that skill set can generate income for the rest of your life. Consider this: if you spend 200 on a course that teaches you a valuable skill, whether it's digital marketing, coding, graphic design, or financial literacy, that skill could help you land freelance jobs or even a full-time position that pays thousands more per year. The return on investment in this case is not 8% like the stock market average. It could be 800% or more. The difference is that you're not just earning money passively, you're actively increasing your ability to create wealth. In an unpredictable economy, this is one of the smartest moves anyone can make. The opportunities in 2025 are broader than ever. Online education platforms allow you to learn almost anything at a fraction of the cost of traditional schooling. For example, you could put a portion of that 100,000 into mastering a high-demand digital skill like data analysis or AI tools. With businesses worldwide integrating technology into their operations, people who understand how to manage and apply these tools will always be in demand. Even a few months of consistent learning can give you a competitive edge in the job market, leading to higher pay or opportunities to work for yourself. But investing in yourself isn't just about career skills. It can also mean building a side hustle that generates income outside of your primary job. For instance, you might use part of the $100,000 to buy equipment for content creation, maybe a microphone, camera, or software for video editing. In today's digital age, creating online content has become a legitimate business. Whether it's starting a YouTube channel, creating an online course, or freelancing in your area of expertise, that initial investment in tools and knowledge can pay off many times over. The internet has leveled the playing field, investment, and those who invest in themselves and take action are often the ones who rise. There's also the angle of self-development that goes beyond money. Investing in health, for example, directly impacts your ability to perform and earn. Imagine spending part of the $1,000 on fitness programs, healthier food choices, or even coaching to improve your productivity and discipline. These are not traditional investments, but they create the conditions where you can show up at your best every day. If you're healthier, more focused, and mentally resilient, your ability to generate income and make smart financial choices improves dramatically. Another dimension is networking and mentorship. Using part of that $100,000 to attend conferences, join professional groups, or even pay for mentorship sessions can open doors that pure investing cannot. One introduction, one piece of advice from the right person can accelerate your career or business in ways that the stock market never could. Relationships are often underestimated as investments, but in reality, they're some of the most valuable assets a person can build. Think about the compounding effect here. When you invest in yourself, the payoff is not just immediate. It compounds just like money does in the market. A new skill leads to a better job, which gives you more money to invest, which grows your wealth further. Better health gives you more energy, which improves your productivity, which increases your income, which again allows for more investments. Personal growth compounds across every area of life, creating a cycle of upward momentum. It's also important to realize that the earlier you invest in yourself, the longer you benefit from it. If you learn a valuable skill at 25, you can use it for decades, adapting as the world changes. Even if a specific skill becomes outdated, the discipline and confidence you gain from learning it makes it easier to pivot into something new. The return on self-investment doesn't stop at money. It creates adaptability, resilience, and confidence, qualities that remain valuable no matter how the economy shifts. So with $100,000 in 2025, after securing a financial foundation, diversifying into index funds, and adding some exposure to emerging trends, I would absolutely dedicate a portion to personal growth. Maybe that means 200 on an online course, 150 on tools to launch a side hustle, 100 on health and fitness, and 50 on books that expand my perspective. These choices may not feel like traditional investments, but they are the ones that pay off in ways far beyond what the market can deliver. The truth is, the best performing asset you'll ever own is yourself. Stocks can go down, real estate can crash, and industries can disappear. But the skills, health, and knowledge you build will always be there working for you. Investment. That's why the final step in investing $100,000 in 2025 isn't just about money. It's about turning yourself into the kind of person who can create and manage wealth no matter what happens in the world around you.